In today's video, I want to walk you through one of the most important financial case studies of our lifetime, the COVID-19 market crash of 2020. Because right now, with the US economy sitting on shaky ground, a weakening labor market, oil prices climbing, and stagflation on the table, I think it is time to go back and study what worked and what completely collapsed. Because the writing is on the wall that we could be heading into another period of serious financial stress. And when that moment arrives, you are going to want to know which side of history you are on. On February 19th, 2020, the S&P 500 was sitting at an all-time high, 3,386 points. 33 days later, it had lost 34% of its value. 34% in 33 days. It was the fastest crash from an all-time high to a bear market in the entire history of the US stock market. 150 years of recorded market data, and nothing had ever moved that fast. The Dow Jones Industrial Average dropped 2,013 points in a single day on March 9th, 2020, the largest single-day point drop in its history at that time. And I want to take you inside those 33 days. I want to show you what the data actually reveals about what survived that disaster, what thrived, and what was turned to dust. Because here is the thesis. Not all investments were equal. The crash was brutal and indiscriminate at first. But what happened next revealed something critical. The difference between wealth that is built on structural reality and wealth that is built on hype, narrative, and borrowed time. And I am going to give you three categories of investments that survived the COVID crash and held their value, and then I am going to show you the other side. The investments that became propaganda. The ones that Wall Street and financial media were telling you were the future, right up until they fell apart completely. Let us start with the first investment. Gold. Listen. Gold is the one asset that the financial establishment loves to mock in good times. They say it pays no dividend, it just sits there, it does nothing. And then a crisis arrives, and suddenly every serious institution in the world is rushing into it. That is exactly what happened in 2020. According to Bank of America data, gold was the best performing asset class of the entire year. The entire year, up 24.8%. Not bonds, not the S&P 500. Gold. The S&P 500 came in second at 16.3%. Let me say that again. The flagship index of American capitalism came in second place to a metal that has existed for thousands of years. $54 billion flowed into gold in 2020. That was the first time since 2010 that gold had taken the top spot across all asset classes. I want to show you this. Take a look at this chart. By August of 2020, gold had hit an all-time record high of $2,030 an ounce. And look at what was happening in the background. The Federal Reserve was cutting rates to zero and printing money at a pace that had never been seen outside of wartime. The dollar was being debased in real time, and gold told you the truth about it while the politicians were busy telling you that everything was under control. It is as simple as that. Gold is not just a shiny rock. It is a report card on what central banks are doing to the currency in your pocket. And in 2020, that report card said, "Warning." Now let us move to the second investment that survived. And this one is more nuanced. I want you to pay close attention because this is where most investors got it half right and still lost everything. The winners were not all of technology. The winners were specifically the companies that provided essential digital infrastructure. The companies that the entire global economy needed to keep functioning when the physical world shut down. I am talking about Amazon, Microsoft, and the cloud computing sector. Take a look at this. Amazon stock finished 2020 up approximately 76% for the year. Not 40%, not 50%, 76%. And here's the reason this is not just a lucky trade. Amazon Web Services, the cloud division, crossed $10 billion in quarterly revenue for the first time in history during the pandemic. Because when Netflix, Zoom, Slack, and every company on earth shifted to remote operations overnight, guess whose servers they were all running on? Amazon. Revenue for Amazon's first quarter of 2020 alone came in at $75.4 billion. A 26% gain over the same period in 2019. This was not a pandemic bump. This was the pandemic accelerating a structural shift in the global economy that was already happening. Digital commerce, cloud computing, and remote infrastructure were not trends. They were the new foundation of economic activity. And Amazon was the backbone of all of it. Microsoft told the same story with its Azure cloud services, seeing demand surge in ways the company had never seen before. These were not speculative bets. These were the picks and shovels of the new digital economy, and the data confirmed it. But you might say, Brian, what are you talking about? Technology stocks crashed too in early 2020. And you are right, they did drop initially. But here is the critical difference. The structural demand did not go away. It accelerated, and that is the lesson. When you are invested in something that the world genuinely cannot function without, the crash becomes the buying opportunity of a generation. That is the difference between infrastructure and hype. And I am going to come back to that point in just a moment because it is the entire story behind what turned to dust. The third investment that survived, US Treasury bonds. This one tends to get overlooked because it is not exciting. Nobody makes a YouTube video about Treasury bonds. But listen, in the first quarter of 2020, when the stock market was in free fall and panic was everywhere, the 10-year US Treasury yield hit a historical low of 0.33% on March 9th of 2020. Now here's what that number means in plain English. When yields fall, bond prices rise. Money was flooding into US Treasuries at a pace that drove yields to levels never seen in the modern era. Investors around the world were so terrified that they were willing to accept a return of nearly zero just to park their money somewhere safe. US Treasuries returned 8.2% for the full year of 2020, according to the Bank of America data I showed you. 8.2% in a year when the world was coming apart. And that is not even counting the flight to safety gains in the March crash itself, when institutional money dumped everything else and ran straight into government bonds. Now, I know what a lot of you are thinking. You are thinking, Brian, treasuries are boring. Treasuries are for old people. My broker told me to be in growth stocks. They are living in ignorance. They are living in bliss. Because the purpose of treasuries is not to make you rich in good times. The purpose is to make sure that when a 34% crash happens in 33 days, you are not the person liquidating at the bottom to cover your margin calls. But here's where we have to talk about the other side of this story. Here's where we have to talk about what turned to dust. Because this is the part that the financial media does not want to revisit. They spent 2020 and 2021 telling you about the new economy, the pandemic winners, the future of work, and then reality arrived and it was unsettling. Take a look at this, Zoom Video Communications. In October of 2020, Zoom stock hit an all-time high of $588.74 per share. The stock had risen 850% in 10 months from December 2019 to that October peak. The financial media called it the defining company of the pandemic era, the future of human communication, the new normal. Everyone from your financial advisor to your retirement plan was being told to hold Zoom. And then what happened? The stock is currently trading around $82, down approximately 86% from its October 2020 peak. 86%. That is not a correction. That is a destruction of wealth. If you had invested $10,000 in Zoom at its peak in October 2020, you would have roughly $1,400 left today. And the people who got hurt the worst were not the hedge funds. The hedge funds got out. The people who got hurt were the retail investors, the regular people who were told this was the future. They bought the narrative, they held, and they watched their savings evaporate. And Zoom was not alone. Take a look at what happened to cruise stocks. Carnival Corporation finished the year 2020 down over 56%. Norwegian Cruise Line was down a similar amount. United Airlines finished 2020 down more than 50%. And then the single most bizarre moment in the entire history of oil markets. On April 20th of 2020, West Texas Intermediate crude oil futures briefly traded at negative $37.63 per barrel. Negative. People were literally being paid to take oil off their hands because there was nowhere to store it. The economy had come to such a complete standstill that physical demand had evaporated overnight. Real estate investment trusts lost 7.6% across the year, and commodities as a whole lost 15% in 2020. So here's the real story versus the mainstream story. We were told by the financial media and the momentum traders that the pandemic darlings were permanent transformations. Zoom, Peloton, a dozen other companies trading at price-to-sales ratios of 100 times their revenue. 100 times. That is not investing. That is gambling dressed up in a business suit. The mainstream story was that the pandemic had permanently changed human behavior, and these companies were the forever winners. But the data doesn't support that at all. The moment the world reopened, the speculative premium evaporated. And the companies that were built on genuine structural need, gold, cloud infrastructure, safety assets, those held their value. Because they were not selling you a narrative, they were providing something the world actually needed. Now, why does this matter today? Because right now in 2026, the economic conditions are deteriorating in ways that look unsettlingly familiar. The labor market lost 92,000 jobs in February. The unemployment rate has ticked up to 4.4%. Oil prices have been climbing aggressively. Core PCE inflation is running at 3.1%, and the Federal Reserve is stuck. They cannot cut rates without inflaming inflation, and they cannot hold rates without watching the labor market crumble further. I showed you that the Federal Reserve's own projections revised inflation higher, and they still refuse to commit to a clear path forward. That is not confidence. That is an institution that knows it is running out of options. And here's the projection. Here's the warning. If this trend continues and the economic data keeps moving in the wrong direction, we are going to be in serious trouble a year from now. And when the next crisis arrives, because based on everything I am seeing in the data, it is a question of when and not if, the playbook is not going to change. Assets with intrinsic value, scarce assets, essential infrastructure, and safety instruments are going to hold. Speculative assets built on narrative are going to collapse. They always do. The difference between the person who comes out of a crisis with their wealth intact and the person who loses everything is almost always whether they understood this distinction before the panic started. Not during it, before it. The writing is on the wall. I know that this is not comfortable to hear, but you deserve to know the truth. And the truth is that the data has never lied to us. Governments lie, politicians lie, media narratives lie, the data does not. If you want to stay ahead of what is happening in the economy and the markets, subscribe to this channel. I put out daily updates and I give you the numbers straight without the spin. Thank you so much for watching. Have a very nice day. Take care.